Alan Porter. Alan, what's going on, man? How are you?
Excited today to talk about these particular topics because people need to become educated on their financial strategies.
You have the way to be able to not worry about money again, Alan. The people Alan Porter's specialist he's connected with are the real deal, Holyfield. You trust me, I'm utilizing them. My clients are utilizing them. And this is why you need to connect with Alan today and myself today, because we have the team of professionals to make your life a lot easier. All right, so the topic today is turning retirement savings into guaranteed income. What most plans miss. Alan, why do you think so many people are focused on saving for retirement but overlook how to turn that savings into steady income?
It's called the accumulation gap, and it refers to the difference between what people think they can safely withdraw and what they actually withdraw each year. And like I said, and I've said it many times, Neil, they used to say a 4% distribution rate is a safe distribution rate for 30 years, indexed at 3% for inflation. But it's actually about 2.8% right now. But if you get the stock portfolio or something like that's not guaranteed. There's financial vehicles out there that you put your money in that are guaranteed with a lot less money going out. And I'll explain that in a few questions. But why does this matter? Because of longevity risk. Retirers are living longer, drawing too much too soon increases the risk of running out of money before you run out of money. And Neil, that's the number one fear in retirement. You've got market volatility, sequence returns risk. 99% of people don't even know what this is. And they're in retirement. They've got millions of dollars in their stock portfolio, and their fee-based advisors don't ever tell them about it. And I think it's criminal. That's my own personal feeling. But I'll just tell people what it is real quickly. Let's say you're 65 and you go to retire, you have $1 million in your stock portfolio, and you took that 4% distribution rate out. That's $40,000. All right, what happens if your market drops 10%? Now that $1 million goes down to $900,000 minus the $40,000 you took out, minus the fees you paid that financial advisor, whether you make money or not. And then what happens if 2008 happens again, where we went down 38 to 52%? Neil, you're going to be out of money the fifth year or sixth year. Average 401k only lasts 4 to 7 years. If you've got you take money out of a depleting income, a depleting asset, nothing put back in, you're going to be out of money worse than to the ninth year. And the difference is if you lose money in the first 2 to 3 years of a 10 or 20 year period, as compared to the last 2 to 3 years of a 10 or 20 year period, you're going to be out of money. And you've got to get a less distribution rate, or you've got to get your money from someplace else. You've got also inflation and rising costs and taxing. I show people how to have a tax-free retirement. They have no idea how much taxes are going to cost them in the future.
Absolutely, Alan. It's a crazy world we're living in that way. Let's talk about, can you break down the bucket strategy and how it helps retirees manage income across different horizons?
They always talk about the Social Security, savings, and a pension. That's the old three-legged stand. Now, there's hardly any pensions around. I think 19% of pensions, but 16% work for the government. Social Security is it's not stable because it's scheduled to run out of money in 2023 or 2033, and then your savings account. But people's savings, now this year they started saving more. But for the past decade, people are not saving enough money to fund their retirement, and they're saving in the wrong vehicles. Here's a perfect example. We've been inundated by the propaganda of Wall Street to invest in your 401k or a stock portfolio to save for your retirement. I hate to say this, but there's fees. 58% of people don't even think there's a fee on their 401k. A 1% fee, Neil, in a 30-year period will reduce your income by 1/3. The average fee in a 401k, according to Lap Times and Forbes magazine, is 2.99%. People are going to have less than half of their money when they go to retire, and then they're going to hit with taxes anywhere from 20 to over 55%, possibly more. And they have no idea about this. And then all these other risks come in. Sequence returns risk, longevity risk. It just goes on, and they're not prepared for it. It's a lack of education is what it is.
It's definitely a lack of education, and people just aren't understanding it. And how are people dealing with these 401ks, Alan? They're not doing it right. They're not utilizing the 401k correctly, and they're not looking at the fees that are going to hit and all these different things. It's ridiculous, isn't it?
First off, there's other vehicles out there besides a stock portfolio and a 401k. I've got 5 index universalized insurance policies that I built myself. They're properly structured, and I quit paying on them 2 years ago. I'm 72 now, and I took my wife's TSP account, paid the taxes on it, and now her money's in a fixed index, not a fixed index annuity, but a cash value life insurance policy. And 2 years ago, Neil, I could have taken over $100,000 a year out every year tax-free. It's a $1.5 million death benefit that I can use for long-term care, 90% of it at zero or no taxes, which I paid for pennies on the dollar. It's in my opinion, in the opinion of properly educated advisors. And I'm a certified financial fiduciary. I'm a certified tax and business advisor. But in my opinion, and like I said, the opinion of properly educated financial advisors, cash value life insurance, when properly structured, is the best. I used to say IRS approved, but I can't say that anymore. Tax code approved, tax-free retirement system available today that eliminates all the risk in retirement or mitigates them. Like I've said, sequence returns risk. Number one fear in retirement, running out of money before you run out of life. Longevity risk, which is a risk multiplier. I can eliminate Social Security, the taxes on Social Security, the means testing Medicare Part B, which alone will be thousands of dollars per year. Sometimes I can eliminate, but sometimes I mostly mitigate long-term care risk, which costs between $50 to $200,000 a year for pennies on the dollar with tax-free money. I can eliminate market risk. I can eliminate government risk. All these risks, a stock portfolio, a bond portfolio, real estate, CDs, savings accounts, money market funds, mutual funds, they only compound. Like I've said many times, Neil, it's not about rate of return retirement. It's about distribution of your assets. And you've got like buckets. I've got 5 buckets of money that I can my money from for retirement. And one of the things that people do not understand, it's called an HECM, home equity conversion mortgage. It's a type of reverse mortgage, but you've worked hard all your life to pay for your house. It's time for your house to start paying you back. You can set up, especially if you get your house paid for, you can set up an HECM, home equity conversion mortgage, to enhance your retirement, even if you're not through paying on it. If you've got enough equity in there, you can eliminate your house payments. There's many things out there that people don't understand, and all they've heard all their life is, oh, it's a reverse mortgage. It's terrible, it's terrible, it's terrible. They don't know. They're not educated on it. They've heard it from their cousin or Joe that works at Walmart or something. They don't know. They need to talk to somebody that's certified in taxes, certified as a financial fiduciary, and talk with me or somebody that has my qualifications, because it'll change your financial future.
Taxes can quietly erode retirement income. What is your favorite tax smart withdrawal strategy retirees should consider?
One of the things is a Roth conversion. And I've got a plan, it's called the Roth Accelerator. We can take people's qualified plans, pay the taxes in the plan itself, and give them protection with guaranteed income that will last for till age 120. And then the death benefit you can use for long-term care, completely tax-free, up to 90% of it. Again, you eliminate the risk in retirement and like required minimum distributions. There's no required minimum distribution with cash value life insurance, but there's so many things out there. All this stuff I'm talking about, Neil, ought to be taught in high school, but it's not. I've got doctors with PhD degrees in accounting and finance. They have no idea what I'm talking about. It's just like one of the things I show people, how to become their own bank, Neil. That's absolutely huge. I've been doing it for over a decade and a half. Think about all the money that you spend on car payments. You're paying compound interest to the financial institution, and that money's gone forever. It'll never compound for you, but it'll compound for them. But what I did, just like last year, I bought a new car. I borrowed, I don't know, let's say I borrowed $40,000 for the car. I'm paying myself, because in cash value life insurance, Neil, you've got 2 piles of money. You've got your cash value, and you've got your death benefit. When you take a loan out against your cash value, it doesn't even affect that cash value. That continues to compound using indexing strategies or fixed rates. It's just a lien against the death benefit, which is hundreds, if not millions of dollars or more. And you don't even have to pay it back if you don't want to. It's just coming off the death benefit. So, but what I'm doing, I'm paying myself. I'll have my car paid for a couple of years. But let's say I'm paying $1,000 a month on this. Okay, if I took this out with the bank, I'd be giving $1,000 to them, not to me. It will go for them. But when I have my car paid for, not only will I have my car paid for, but I paid myself, and all that money, I'll have tens of thousands of dollars more in cash value life insurance policy. I've been doing this, like I said, for over a decade and a half. Why people don't do this, it's just a lack of education. That's all it is. All
right. The best place, you do not charge for consultations. That is powerful. So you can get information, and Alan's available. You call him at 910-551-1046 or go to strategicwealthstrategies.com or email you at strategicwealth0@gmail.com. And you don't charge for your consultations. That's huge.
Just one last thing, Neil. What I do is I show people how to reduce and possibly eliminate both debt and tax, set them up with a tax-free retirement. I show them again how to become their own bank. I eliminate the risk in retirement. But one of the big things I'm doing now concerns healthcare. And I can show people how they can reduce their healthcare anywhere from 20 to 30% over what they're paying out right now. But I have a preventative healthcare program that's no cost, no net cost to the owner, no net cost to the employee. The owner will realize a savings anywhere from $500,000 to $700,000, $500 to $700 a year in FICA taxes per W-2 employee. and you got 100 employees, that's almost, I don't know, what, $50,000 or up to $50,000 to $70,000. But the employee with this preventive health and wellness program, nothing doesn't cost them anything. They'll average an extra $100 in their paycheck each month. They have 1,100 drugs at zero copay. They have a 8% higher production rate and a 7% higher retention rate. It's got a plethora of benefits that takes a while to go over. Give me a call if something like that would interest you.
All right. Appreciate it, Alan. That was the Strategic Wealth Strategies podcast, guys.